What's up, guys? Welcome to another Market Radar podcast. Hope you've had a great week. The NASDAQ is finally pulling back, giving some relief to the bears. I think, what is it, 50 days of being above mid-vamp? We haven't
Yeah, it's
seen
pretty
that.
crazy.
We haven't seen that in a long time. I think it was November 2020, the last time the NASDAQ has stayed above mid-vamp for this long. And we're still above it. We're not below it, even after this little drop that we had going into the end of the week. But if you are bearish, step one to going lower is we've got to break through mid vamp. Next,
And that's that white line, right? So that's this
yeah,
white line right here. We have to break that and then go take it from there.
yeah, and we got to hit lower vamp then. So these vamp, if you don't know, volatility adjusted market projections. Those are realistic places where the price can move in the short term. So 14,500, very realistic to get there next week. That is possible. And to get there, you got to break mid vamp first to really get that momentum to get down there. And so far, we're not seeing that. But next week is actually a pretty heavy week if you want to go to the calendar. So we've got quite a lot going on. New home sales, durable goods orders. Powell is speaking on Wednesday. We've got GDP and jobless claims on Thursday. So there's a lot going on next week, and definitely further drops in the NASDAQ can continue based on what kind of data we get coming out.
Right. And then also on Friday we have the infamous PCE data that comes out with the personal income and outlays. So that's going to be what FinTwit's going to be salivating about, because obviously the Fed has made it very clear that they care about PCE. In pretty much all their speeches, they mention PCE. So FinTwit's going to be jacked up and junked up on Friday. So be aware for that.
Yeah. So let's get into bonds. Bonds are also holding above mid vamp barely. We're definitely not seeing deflation being priced in by bonds right now, but it's just a lot of chop going on. What do you think about that?
Right. So, okay. Simply put, bonds are at a junction where they're going to need this growth slowdown. And we spoke about this briefly last week, but bonds are going to need to see a significant or a material slowdown in the economy to the point where those deflation risks accelerate, and or a material decline in inflation where it is beyond the point of return, meaning, there is pretty much no risk of a rebound. That's what bonds are waiting for. Um, from a surface level, obviously, it can get very complex from there. And we can take a quick look at the Fed funds forecaster. And though to those that are new, you probably have no idea what this chart is, but it's basically a term structure view of the Fed funds futures, showing us where the Fed funds future or the Fed is expected to bring rates over the next 12 months. So what you can see here is we are expected to have a rate above the current rate that we're seeing now by December of this year. Again, for those that are new, by looking at this, you would say that's normal. The Fed has said that they're not going to cut rates in last week's meeting. Pretty clear, right? But earlier, just a month ago, the market was still looking at the Fed cutting rates into the end of the year. So this is a pretty strong change in market in anticipations that are being priced into the market based on where the Fed would go by the end of the year. So this again is just the market confirming the fact that the Fed is probably not going to cut rates at all this year, which we've been saying that for at least 5 to 6 months now. Finally, the market's picking up on it. Now the only question comes, will the Fed actually hike rates at the next meeting? We don't think they will based on what we're seeing right now, but obviously PC on Friday, that's going to get people really thinking and talking about this again. But as of right now, I do think that there is a higher probability than the market's pricing in that the Fed will hold rates where we are right now throughout the rest of the year. But
Right.
we'll
And
get
that also is contributing to this bond chop and why we're really not seeing that
exactly.
upward momentum in bonds, because as the market's pricing in the Fed holding rates for the first foreseeable future, as they said, Powell even came out and said we're going to be holding rates for what, 2 years?
Oh yeah, he said no rate cuts for like 2 years.
Yeah, no
It's
rate cuts
comical.
for two
Comical.
years. That's going to scare bonds and keep them pressured downward. So they're kind of being held back because of that. As soon as we start seeing some weakness in the economy, some reasons for cuts to start being priced in, that's when we can see the bonds really start moving, and we would probably get that kind of move that we saw back in March during
Right.
the SVB collapse. Once things start hitting the fan, there's like reasons for cuts, then that's when we'll likely see the bonds start to move. But as of now, everything is pretty stable. There's nothing
Right. No,
breaking.
that's a good point to basically segue into the concept of the soft landing, right? Because realistically, soft landing wouldn't be that great for bonds, right? Because what should happen in a soft landing is inflation should come down, right? And the Fed should be able to ease policy slightly. It shouldn't be dramatic because that would be a recession, hard landing, right? Soft landing. So bonds wouldn't perform that well. And growth would basically be stabilized and due to the fact that unemployment isn't broken. So I want to simplify that. The soft landing isn't bringing down inflation without really killing growth. It's bringing down inflation without crushing employment. So obviously, if you don't crush employment, growth should basically stay more robust because growth should stay or should be more resistant, right? Because you're not destroying the labor market, which is going to affect growth. But the problem with this soft landing, and we keep saying this, is it's impossible because most, and it's impossible, but it's going to be most likely coined as possible after this is all said and done because it's most likely the market's telling us that we're most likely going to see a soft landing. Now, what I mean by that is it's going to be coined as possible, but it's impossible. You might be confused, like what the hell does that even mean? And what that basically means is the window of observation of this whole soft landing is going to be basically goalposted where like, oh, look, inflation came from 9.1% down to maybe into the threes, right? Or maybe even twos. And unemployment didn't skyrocket, right? And everyone's going to say that's the soft landing. But if you look at unemployment historically, even after inflation peaks and starts rolling off, unemployment tends to actually pick up and roll out and upwards. So if you put those goalposts based on where inflation is, you tend to miss this entire move in unemployment thereafter. And it's very easy to credit something with a soft landing when in reality, it's just a generic market cycle where we all know that the Phillips curve is skewed. We've spoken about this in the past. What the Phillips curve basically is it's this idea that unemployment and inflation are extremely correlated, and it's been disproven in recent times, where basically unemployment has stayed relatively low with low inflation, which is rather unusual based on this Phillips curve structure, which the Fed likes to reference. And the Fed's basically, if you don't understand what Powell is saying when he's like, when he's consistently saying our mandate is maximum growth and maximum unemployment and price stability, those are our two mandates. What he's basically telling you every time he says that is we follow the Phillips curve. We believe in the Phillips curve. So to have maximum employment, we need low inflation.
Right. And so
Right.
what is going to cause the wave of unemployment? Is it just holding rates
no,
where
so
they're
yeah.
now, and
Yeah.
something's just going
So
to crack at some point, or what?
So that exactly. So let me get back. Let me wrap up the Phillips curve here. So the Phillips curve, like I just said, is useless under a certain degree, but it's when we get to the extremes, the north of 5% inflation, where things start to get more correlated towards unemployment. Because again, if you have high inflation, you have large demand. Now you can claim that there's supply chain disruptions, right? But to answer your question, yes, high interest rates are going to put a burden on the economy. We're already seeing the effects of high interest rates and just break even inflation rates in small cap companies being obviously down so much since the Fed started raising rates. And in general, we're seeing loan growth is slowing down. A lot of things are slowing down, which is to be expected. The Fed is hiking interest rates. They're tightening the economy. And to those people that want to argue that hiking rates causes inflation, they tend to have a very limited view on the aspects of money creation in itself, right? So they believe that money can just be created, which it can. So this is where the dynamic gets interesting, right? Money can be created to a degree if there's enough demand. If the growth of an economy outweighs the money supply, you actually get deflation, right? So you could create X amount of dollars and basically stabilize that and actually create money and not create too much inflation. But if you just look at the Federal Reserve, I mean, the amount of money we print, I mean, there's obviously not enough growth to back that up, and that's why we have excess inflation. So long story short, when the Fed hikes rates like this and they hold them, things start deteriorating. Companies that are highly levered have trouble borrowing additional capital at higher rates when they have to refinance, and it slows growth in many facets. Companies may because they have higher rates, right, to refinance debt. Maybe their operating income needs to come down, meaning they have to fire people that aren't required to meet the job demands that are essential to run the company, and therefore unemployment picks up. And these are all layered effects of just hiking interest rates, and they happen in maybe. For example, higher interest rates also means higher car notes, right? So people are less incentivized to buy cars, right? So in turn, car makers, this is just a chain reaction of effects. It all starts with borrowing, and if the cost to borrow is higher, the growth will there be slower to a certain degree.
Right.
And so that will slow the economy down. The question isn't about, that's not something else I think we need to answer. It's not a question if the Fed will slow the economy. It's pretty much almost guaranteed at these rate levels. It's just a matter of how long it will take for them to slow the economy.
Yeah.
And
well, so historically, the unemployment rate rises very rapidly whenever a recession does hit.
Right. It's almost unpredictable.
Yeah,
right?
It's almost unpredictable. But how? Like, what can we see? What can we look at to foresee that? Is there anything, or is it really just you just got to wait for it? Something breaks eventually. It becomes a cascading effect, and everyone gets laid off all at once. Does anything happen before that, or is it just a waiting game?
I think you have to take a broader view instead of trying to time unemployment specifically. You have to look at it from a market perspective, right? Because again, we can't really trade unemployment, right? You can't really long unemployment. Well, you can synthetically, and I'm about to explain how that comes about. But let's just look at bonds, for example, right? If we're going to go into a real recession where unemployment picks up, bonds should do very well, right? Bonds should be a deflationary event where bonds will move. So a way to gauge this unemployment move is to look at bonds and say, how close are we to going into that bullish trend and really getting into that deflationary regime? And until obviously unemployment hasn't really gone anywhere, neither has bonds. So it's something that you can basically assimilate with each other and say, okay, well, if bonds aren't moving, well, the market isn't really too shocked about a potential recession just yet. And therefore, it's very unlikely that unemployment is going to explode out of nowhere. Obviously, investors as a whole would start positioning themselves for an actual recession where unemployment may actually rip before bonds move. Depending on how that works, I don't think it matters too much which one goes first. It just matters is that we catch the move in bonds when the move happens, or equities if there is no recession, et cetera. It doesn't really matter in terms of timing in unemployment to a degree, because if there is a recession from unemployment, bonds would likely yield a very ample opportunity.
Right.
But let's actually take this from here and go into Bitcoin, because I know this has been a talk of Twitter lately. Everyone's CT, right? Crypto Twitter is going crazy. Everyone's like, oh my God, Bitcoin's at the highest since 2022 or something like that. April of 2022, new 52-week highs. It's breaking out. It's up 85% year to date. It's up 20% in the last week alone. This is a bull market. And my answer to you is yes, this is bull. This is bull. This is not bear. This is bull. It's really simple. Okay. If you have DDAP on your chart and DDAP is green, it is bull. It's not complicated.
Yeah.
right?
Honestly,
And
just trading Bitcoin solely using DDApp trends, you would avoid so many drawdowns and catch pretty much every move you need to catch in Bitcoin just
yeah,
following DDApp.
crazy. I know. But like, let's go back to just recently, right? Um, we put up a tweet here in last week saying that a lot of people were like, "Oh my God, Bitcoin to 20K. Get your bear pants on. We're going down." And sure enough, Bitcoin went straight fucking up, got obliterated. But why did that happen? Well, number one, Bitcoin didn't confirm a bearish trend. So, well, if Bitcoin's not bearish, it's not bullish, it's neutral. It can go either way, right? A lot of people were thinking, "Oh, this is it for Bitcoin. Down we go." And a lot of people were geared up this way because they look at the old Nazi, right? Nazi's up 35% year to date, and they're like, "Oh, maybe Bitcoin's going to lead the Nasdaq lower." I'll jump on the short train here. I'll jump on the short train on the Nasdaq. Maybe I'll generate some alpha. Cool. And sure enough, Bitcoin did drop a little bit. And then what ends up happening is everyone starts getting squeezed and obliterated. And the reason for this is because Bitcoin is not bearish trend. If Bitcoin was bearish trend, the odds of this happening are a lot lower. Doesn't mean obviously for Bitcoin to go from a bearish to bullish trend, it has to move up through Momo. But you never had a trend flip confirm, so there was no reason to ever think Bitcoin was done. At one point, we did see a flashing bearish trend. It never closed. We saw this potential for there to be a bearish trend formation. Never happened. Bitcoin moved higher. It just goes to show you, no matter what the regime is, this is why DDAP is so important. This is why pretty much every other macro guy on Twitter can't different. They don't know if they're coming or going when it comes to actual asset class pricing, because they look at the asset and they say, "We're in X regime, boom, just do it, full send it," and then get smoked. They're like, "Oh, you know,
Yeah.
it's a
Yeah, the regime
growth."
the regime gives you the regimes give you asset allocation, so you know, okay, these assets typically perform well in these regimes, but DDAP gives you that timing that
Right,
no one else
right,
has. And
right, and
also, it's just an extra layer of filtering. Some assets, we have a list of assets that perform well and perform poorly in each regime, but it's not clockwork. Nothing is that linear in the market. Sometimes crude oil is just not going to do well in an inflationary regime. So
let's
it
talk about crude oil
changes.
right now.
It
Let's
changes
talk
all the
about that.
time. So that's why DDAP is so important. Like for bonds, for example, a lot of people were thinking, oh, deflation is coming. A recession is coming, is what they were saying back in 2000, back in 22, and they were longing bonds. But little did they know, bonds were bearish trend. Bonds were not the play the entire year. But those linear thinkers that purely just see a regime and they allocate their positions towards whatever assets typically perform well in that regime, you're pretty much half blind. You're
Yeah,
trading
that's a
half
very good
blind.
point. That's a very good point, because I think, wasn't it around here that we said the bond chop risk is like extremely elevated, right? Something
Yeah,
around, it was somewhere around here. And
yeah,
sure enough, we got exactly that. And why did we get exactly that? Because bonds were so far from trend. It, our view was, it wasn't very complicated. The fight on inflation was pretty much over, but you could have figured this out back then, which we've been very adamant about, or at least coming to an end. Um, and trend was so far that for bonds, this could be one giant counter trend move and possibly bounce back and pretty much go nowhere until we got above Momo. And bonds didn't even get that high. They just ended up actually peaking out shortly after we said this, and they've gone nowhere since. And we're still pretty much around that same area. And that goes back to the point where a lot of people were thinking recession. If you lived in markets in 2022, all you heard was recession. Recession, recession, recession. Yeah, no recession play worked. Why? The trends weren't lined up. It's that simple. That's why we use a checks and balance. We use this double-edged sword of checks and balances. If the system checks out, but DDAP doesn't balance it out, it's no good. Oh,
Right.
good.
And that's
That's what
important
happened.
when you use leverage. We use
Oh,
triple
100%.
leverage on our Aries model, and you don't mess around when you're using leverage. Leverage can either be the best thing you've ever used or the worst thing you've ever used.
Here's a great
And
example.
we're not
Here's,
trying to ruin our lives. we
here's
need
a good
we
example.
need conviction, and that's exactly what our system's about.
If you take TMF from the TMF peak in this, which is a long component in Aries, if you take the December peak to where we are right now, you're down 22%. Okay. If we go back to ZB, which are long bonds, and we take the December peak to where we are right now, that's negative 4%. Let's leverage that 3 times. It's negative 12%. You've lost over 10% in time decay of chop decay. Basically vacuum volatility. You've gotten eaten up in. So that is one of the main reasons when you hear us say avoid the chop, if you're long straight up TLT, you're a simple investor, you want to buy TLT in recessions, long bonds in long equities in growth regimes, then buying TLT probably wasn't the worst idea. You're getting the dividend, it's chopping sideways, not the end of the world. But you also had to have the wherewithal to buy it here and not here because there were some macro services out there that were talking about longing bonds in August of 2022. And they said the new bull bond market is here. That didn't end up playing out too well, obviously. And that's, again, DDAP had us away from bonds throughout this whole time because the trend remains bearish. So respect the trends, follow the flow, and just basically take action when there's conviction because conviction doesn't always exist. Sometimes you do have to sit on the sidelines. That's part of the game. But let's actually run over crude as well quickly because this is another one that has people very confused. The inflationists, they want to know why crude is not going up. Again, go with the flow. Bearish trend. We called the move of when OPEC came out in the April in a weekend within I think it was the April 3rd weekend or something like that. The first weekend of April. Sorry, guys, teasing you. OPEC came out and cut production drastically. Everyone's like, "Oh, oil's going to $100 a barrel." Well, we came out first day, Monday. We said, "Listen, first day of the week, Monday. If crude is going to go to $100 a barrel or substantially higher, we need to clear Momo," which was right here. I made this tweet very clear. I said the trend's bearish, inflation's on the downswing. Odds are this move fades. What do we have? Move is faded. Wasn't that hard. I'm not an energy expert. There are people out there that know much more about crude and the energy markets. I don't focus with energy. I don't focus with commodities specifically, and specifically, even more specifically, I mean energy. I've talking about EPA, the EIA and all these production goals. I don't pay attention to most of that. I really don't. So I'm not going to sit here and act like, oh, I knew because of OPEC cutting this and X source of refineries elsewhere. We negate. That's all. If I were to tell you that, I'd be lying to you. It's all bullshit. Realistically, the trend was bearish. Okay, keep it really dumb, simple. Inflation's on the downswing. That's all I need to know. And sure enough, that's where we are right now. So sometimes it makes sense to mute a lot of the noise out. And a lot of you guys, the reason a lot of these big macro guys blow up is not because of call it realized value, right? And we'll make these two things realized and hypothetical, right? So you have realized value and you have hypothetical value. A lot of these macro guys, they provide this hypothetical value. I'll sound really smart, say a bunch of nonsense, right? Make myself seem like I know what I'm talking about all the time, right? It's hypothetical value in terms of like options trading 101, all this bullshit, right? Realistically, you read this thread and you have no idea what the fuck the guy just said, nor do you have any idea of what to do with it, right? And people like that. People like reading things and feeling like, wow, I learned something. But what people don't really care about is what they can do with what they just learned, right? So you have all these people that are promoting this bullshit. And in reality, you get to the point where you don't actually learn anything. You think you learned something, but you have no way of applying what you've just learned. So, long story short, when you look at things, sometimes it's better to take all that hypothetical value and throw it out the window because usually it's only a few things that are required to realize that value and make money off of it. So again, I say this to you guys that are listening that are maybe new. Keep it simple. There's nothing better than a simple strategy, a simple approach, because the simpler it is, the less stressed you're going to be. And the less stressed that you're going to be, the more fun this gets to become, both in and out of the markets. Your life shouldn't be glued to a computer screen. You should be able to go out there, have a good time, and not feel like you're going to get destroyed at any second. Again, this comes back to proper risk management, keeping everything simple, and approaching markets with a smile on your face. Thank you guys for listening, and we'll see you guys next week.